this. All right, so I'll get started. We're going to be talking today about inventory and depreciation, and both of these are critical to your financial statements as far as the value or the amount of profit that you claim or the amount of taxes that you pay have a lot to do with inventory and depreciation. And these are completely different topics than what we've been looking at so far with compound interest and annuities and all those items. So we're going to be looking specifically at how to calculate your inventory cost and value, and it has a big bearing on your, as I mentioned, your financial statements. So what I have on the screen before you right now is what we call a balance sheet, and we're going to be looking at this a lot in chapter 15, but I jumped ahead to chapter 16, so I wanted to backtrack just a little bit. Next week, we'll be doing what's called vertical and horizontal analysis of the financial statements, but I wanted to explain the financial statements and then show you where inventory fits into what these report. So what you're looking at right now is a balance sheet, and a balance sheet is broken into two main sections. One section is your assets, or everything you own, and then the other side is your liabilities, or everything you owe to other people. And so it's broken down that way, and we call it a balance sheet because all your assets should always be equal to all of your liabilities plus your owner's equity. And owner's equity is really nothing more than saying what cash or what value, cash-wise or in assets, does the owners own. And then liabilities is everything you owe. So if you take all of your assets and you subtract all of your liabilities, then what you have left is what you actually own as an owner of the company in your stock or whatever it is that you own. So it's the normal classic formula that is assets equal liabilities plus owner's equity, but really a better way to say it is assets minus liabilities equals owner's equity, and that's what you have. So everything, after you pay off everything you owe, whatever you have left is what your equity is in the company from your assets. So what you're looking at here is all of your assets. So it's broken down again into what you own. And then you have current assets. So those are things that are really quick to turn into cash. So of course, cash turns over real quickly. Accounts receivable, that's money that people owe you. So there's a cash value to that you can get fairly quick typically. There's inventory. So here's where inventory fits in. I highlighted it yellow just to show you that it is an asset, even though it's finished product, or it could be raw materials in stock somewhere. It's all valuable. It all has value. So we call that inventory, and that's a current asset. And then you have something like prepaid insurance or prepaid taxes, things like that would fall under your current assets because those can quickly be turned into cash. They're more liquid. And then you have your plant, property, and equipment. These are more difficult to get rid of and turn into cash. But in this case, this particular company has zero land and buildings. This is Sienna's Health and Fitness. They haven't bought a building yet. They're leasing. They have delivery vehicles. They have blenders. They have forklifts. They have delivery vans. They have investments that they're putting into to buy the land they want to buy, etc. So they have a total assets of $1.886 million. That's their total value of everything they own as a company, everything from cash to all their physical goods that they own. And then they have their liabilities. If you notice, it's everything they owe. So they owe accounts payable. That's what you owe other people that you've bought on an account. They have salaries payable. That's what you owe your employees for the work that they've already done. Then you have taxes payable. Those are going to be coming due pretty soon. So you need to have that set aside. Then you have rent payable. So those are all your current liabilities. Again, these are the things that are going to be due in the very near future, usually 3 months or so or less. And then you have your long-term liabilities. That's things like your land and building mortgage. Again, they don't have anything yet. They're going to plan on buying something soon. But they do have an equipment lease of $7,000, and they have van loan payments of $723. So their long-term liabilities are $8,000, and then their short-term liabilities, all those accounts payable and accounts salary payable, all that, it comes out to about $443,000 in total liabilities. And then again, if you minus the 1.8 million, you minus the 443,000, that gives you what we call your sorry, your owner's equity right here. So basically the owners in this company right now own about $1.4 million in assets after all of their liabilities are paid. Now notice if you add up all your liabilities and all your owner's equity, so you add this and this, it comes out to your total, which is 1.86 million, 886 million, which is the same as your total assets. So that's how they figure it. So that's what we call the balance sheet. Both sides need to be equal, or else somebody made a mistake somewhere. But I want you to note the main thing here is inventory. So what would happen if that inventory cost goes up? Well, that means that my assets are higher, right? I have more assets. If it goes down, that means I have less in assets. It's pretty simple. So how I calculate inventory, I can calculate it one method that shows that it's actually worth more, and that would raise my assets, which look really good if I'm trying to sell the business. Or if I want to pay less in taxes at the end of the year, which we'll see in a minute on the income statement, then I want to calculate my inventory so it looks smaller, it looks lower. And the different ways that you calculate inventory allows you a little bit of flexibility in your income statements and in your balance sheet to say where you're at as far as assets. Now, again, if I want to sell the company and I want it to look really good, I want my assets to be as high as they can. I want my income to be as high as I can, because I want to make sure people know that I can make a lot of money. But if I'm not selling my business, I want to try and get the least amount of taxes paid. So I'm going to try and show less amount of income. And as a result of that, if I show less income, then that means my taxes are going to be less, which means I pay less taxes. So it's kind of a catch-22 between the two, but that's where inventory and how we calculate it becomes important. In fact, I'll show you on the next sheet, which is the income statement. So this is an income statement. This shows, this is the other main financial statement that every business has. By the way, both of these documents, every business generates. It's pretty much the standard for every business worldwide. They all have income statements. They all have balance sheets, and they all have statements of cash flow, because you want to make sure you don't run out of cash. But this statement shows all of your earnings over a period of time. Now, the balance sheet is just a snapshot in time, the sheet we were looking at before. You can basically say, where do I stand right now? And you take a snapshot and it tells you where you're at the moment, because everything's constantly changing. Where income statement is usually at the end of a period of time. So if you notice, this income statement is from August 22 to August 23. So this is 1 year's worth of information. So it gives me all my revenue. So my total sales, my returns. In other words, I have to subtract that because I returned that money because maybe somebody returned the goods they bought. And then I've also given some discounts. So out of the 1.645 million, I gave back almost 15,000 in refunds and discounts. So that gave me a total sales of 1,629,000 for that year, August 22 to August 23. Now, this is where inventory comes in, is we call it cost of goods sold. So this is where I'm calculating the actual cost for me to make the products that I make, the materials that go into it or whatever. And so we call that beginning inventory. Beginning inventory is everything that I have at that beginning of that year, August 22. I had $556,000 in inventory. And then over the course of that year, I purchased another $678,000 worth of inventory or goods or materials or raw materials or whatever it was. So I have a total goods available for sale, finished goods, of 1.2 million. And then I have ending inventory. It means at the end of that year, what do I still have in inventory? I have $567,000 worth of ending inventory. And then I also have a little bit of spoilage. So if I take those two values, I take the 1.234 million and I minus what I have left, that means I sold, or cost of me selling everything came out to $665,065.09. So that's what I spent in order to make this 1.629 million. So if I deduct those two, then I call that my gross margin. So after I take my net sales and I subtract all of my cost of goods sold, it gives me a gross margin of $964,000. So that's what I made before my operating expenses. And that's the next category you see is in an income statement. We also have operating expenses. These are what you might call your fixed costs. These are what you called your variable costs, what it costs to make the products. This is what it costs to do your fixed costs. So like salary, rent, advertising, insurance, supplies, depreciation, miscellaneous expenses, all the expenses that are common to a business, those are also all added up. And I have a total of those total operating expenses of 485,000. So I subtract that from my gross margin, and that gives me income of $478,997 before taxes. And then the taxes on that came out to $54,340. So I have a total net profit at the end of that year of $424,000. Pretty good for a small business. Now, again, what I want to point out to you here is inventory, right? So if I value my inventory high, it's going to show that I'm going to have a much higher gross margin, which means I'm also going to have a much higher income before taxes, which means I'm going to have a much higher amount of taxes, which means I'm going to have a lower net profit. So inventory matters. The higher the cost, the lower my net profits are going to be. But I can calculate inventory to where it shows it as a lower cost. And so if I lower my cost of inventory, that means my gross margin is going to go down. It also means that my net income before taxes is going to go down as well, which means my taxes are going to go down, which means my profits are going to go up. Or excuse me, going to go up. So hopefully I didn't confuse you on that. But the point being is inventory matters. So the higher the inventory, the cost or the cost of it, the higher that it's going to, the less profits I'm going to show at the end of the day is really what I'm trying to get at. So how you calculate, now you might say, well, why does that matter? Because doing it one way makes your inventory costs higher. Doing it another way makes your inventory costs lower. And that's why we do it different ways. That's why businesses choose, they switch back and forth between the different methods that they want to use to calculate inventory. So that leads us then to what are the different ways of calculating inventory? And that's what I'm going to look at next here with page 3. And there are, again, I think I said 5 or 6 different methods for calculating inventory, but this is the most common ones. And the first one is what we call FIFO, first in, first out. That's what it stands for. So you could say FIFO, first in, first out. What that means is if you look at the little picture here, you have a diagram of a truck delivering some goods, and you can't really see it. If I blow it up here, let's see if I can blow it up. I don't think I can. A little bit. You see box number 1 here, box number 2 here, box number 3 here, 4 here, 5 here. So the first ones I put in is box number 1. That means that they're going to be the ones that are in the warehouse the longest, because box 5 I put in last. And if I sell the first in, first out, that means box number 1 is the first one out the back door to TV City. So the first one I put into my inventory is the first ones I sold. Now, keep in mind, that means that the ones that I put in first have been in there the longest. And if they've been in there the longest, that means they're the oldest by date. So the oldest by date are the ones that I sold first using the first in, first out method. So looking at the chart below, I'm trying to shrink it down, but it's not letting me, so I'm going to reload it. So here we have a example. We have a beginning inventory of January 1st, and then we added more on April 19th. We added a few more on July 19th. We added a few more on October 15th, and we added a few more on December 8th, right? So it says if she sold 800, I'm going to change that to 900 because I made a mistake on that. If she sold 900 units using the first in, first out method, what was the dollar value of what she sold and what was the dollar value of the ending inventory? Now, just so you know, in most cases, the problems are asking you for what is your ending inventory value. In other words, what do you still have left after you sold what you sold? But I'm asking you to do both in this first problem because I want you to see the difference between the two. So the first thing that we need to do is figure out how much was her total available for sale during that last year. So I would add all that up, 400 times 5. So basically 400, 200, 500, 300, and 200 comes out to 1,600. So there were 1,600 units available for sale. at a total dollar value, if I add all that up, of 10,900. So I found out, you should do that in every problem, by the way. Find out what is the total available for sale and what is the total dollar value. And then it says she sold 900 using FIFO. So that means the first ones in were the first ones she sold. And if she sold 900 of them, then the ones that have been in there the longest were the first ones she sold. So if there's 900 that she sold, that means she sold these 400, they're gone, right? She also sold these 200, that equals only 600, they're gone. And then she sold that 600, so I have 300 more. That means she sold 300 of these. So now there's 200 left. So we could just cross that out and put 200. All right, so these are all gone. Now, if I want to figure out the dollar value of all those, I could simply do it. I can say, okay, for the 400 at $5 was 2,000. And then for the 200 at $6 was 1,200. And then there was 300 she sold at $7. So I have to figure out that. 300 times 7 equals 2,100, right? So if I add all that up, that comes out to $300. So her the dollar value of what she sold was $5,300 because she sold those first 900. Now, what does she have left? Okay, well, that means if she sold those, what she has left is these 200 and these 300, and then 200 of these. So she has those left. So she has 200, 500, 600. She has 700 left. And the dollar value would be whatever's here. So she sold, she has the 200 from December 8th are still there. So those are worth 1,800. And then the 300 from October 15th are still there, and that was for 2,400. And then she had 200 left at the $7, so I need to figure out that. Equals 1,400. So if I add all that up, 8, 9, 10, 11, 12, 13, 14, 15, 16, 2, 3, 4, 5, 5,600. So she has $5,600 left in ending inventory. That make sense? Any questions on that? So I did both sides. I did what she sold and how much that was worth, which was 5,300. And then I saw what does she still have left? That's ending inventory. What does she still have at the end of the year? She still has 200 from December 8th, 300 from October 15th, and 200 from July 19th. And how much dollar value does that come out to? 5,600. So I just figured out the inventory using first in, first out method. Any questions? Okay. So we're going to go to the next page. We're going to figure out another one. So if you are the merchandise manager at Sienna Health and Fitness, the following data represents your records for the annual inventory figure for a particular item in inventory. Didn't tell us which one. It's asking us how many did we have for sale, and then what is the total dollar value. So if you add all that up, it comes out to 850, and then you add all that up, it comes out to $7,325. So there is my ending, that is my total available for sale. And it says using the FIFO method. So the first ones in were the first ones out. That means the oldest by date. So in this case, January 1st is the oldest by date. And then May came after that. Then August came after that. November came after that. So using the FIFO method of inventory, what is the dollar value of ending inventory? That's what most questions ask, by the way. If 380 items were on hand. So I already know these ones were sold first, right? So I'm going to start from the bottom because these are still here, right? Anything that's still there, the last ones I put in are going to be still there. So 380, well, I have 300 right there. So date, let's put 11/18, 300 units at $875 per unit, came out to $2,625. So those are still there, but then I have 380 units. So I need 80 more. So I need 80 of these that are still there. So August 27th, 8/27, I have 80 units that are still there at $9 each. And that comes out to $720. So if I add them all up, I have $3,345. So that means my ending inventory of 380 units using the FIFO method, first in, first out. So the first one's there, where the first one's gone. So whatever I have left is the last ones I put there. So in this case, it was the 300 from November 18th and 80 from August 27th. Everything else sold. And the dollar value of those is $3,345. Any questions? All right. Next question. Calculate the total number of units available for sale and the cost of goods for available for sale from the following inventory of shaker cups. So it's asking me to, oh, I already put the answers in there. Huh. It was supposed to give you the answers, but anyway. All right. So calculate the total number of units available for sale. So we already did it, 1,100, and then the total dollar value is $17.98 and 30 cents. Missing the 30 cents. So, all right, so that's the total, but it's going to go on to the next page. So we'll have to refer back to this page quite a bit when we do this. So I wish I could put it up on the screen, but I didn't do that. Actually, I have it right here. I can look at it in front of me. Let's see, that's going to be page number 5. Nope. Page I'm missing. Hold on a second. The pause. I apologize. I'm going to have to refer to my sheet because I can't keep switching back and forth to do this. So we're going to use FIFO method, and it's found that there was 550 in remaining inventory on December 31st. So again, if I look at the schedule, that means that what sold, I have 550 left, and what sold, because I'm using FIFO, were the first items in. So basically, everything on January 4th, everything on March 14th, everything on May 25th were all sold, but I have 580 left. So that means I have 1024. This is the oldest ones in there. There's, excuse me, the newest ones in there. So I had 250 units still at $1.60 each, and that came out to $400. So that's 250 of the 550. And then I have 300 on 829. I had another 300. So that puts me at 550, right? At what rate? 177. And that came out to $531.00. And that's it. That is my total. Those are my 550 that I have left in the inventory. And that comes out to a total of $931. So there you go. Now, if you want me to go back, I'll show you real quick. Notice there's 300 on 829 and 300 or 250 on 1024. If I go back one page here to you could see here I had October 24th 250 and then August 19th 300. There's my 550. So if you add those two together, it comes out to 931. So I did it again on that one, ending inventory of 550 units. All right. So back to this sheet. Now we have another one. Calculate the total number of weight sets, 45-pound weights for sale, cost of goods sold available from the inventory, following inventory figures. So if I add them all up, it comes out to 127 and then 1652 or 16,532. And then I'm going to do the same thing here using FIFO. So using FIFO, I have 64 units left. So that means the 25 on June 8th, 6/8, I had 25 still there because they were the most recent ones I put in. That's 25 of the 64. Then on April 16th, I also had 30. So how much does that equal? That's 55. So I need 9 more from February 20th. So again, the cost of these units were $3,375. The cost of those were $4,380, and then 9 times 118. So 9 times 118 equals, did I do the math on that? I didn't do the math on that. Yeah, I did. It came out to $1,062. So if I add all that up, it comes $8,817. That is my cost of ending inventory. is $8,817 using the FIFO, and that's having 64 plates left using the FIFO method. So there's FIFO, first in, first out. You're always going to start when you're considering your ending inventory, what you put in there last, because if you sold what you put in there first, it's gone. So what you have left is what you put in there last, and that's going to be the most recent date. So in this case, June 8th would be the most recent. All right, so let's go to the next method, which is going to be FIFO. Let's see, or LIFO. So here we go. All right, now we look at last in, first out, and all it is just the opposite. Rather than what you first put in, you sell first. In this case, what you last put in, you sell first, which means whatever you have left is what's been in there the longest. So if you notice, you have the same boxes here. You have 1, 2, 3, 4, 5. They're putting them in the warehouse. They're stacked up. But when they go to sell them, what do they take first? They take number 5. So the last ones I put in are the first ones to be shipped out. So it's just thinking the opposite direction. So again, using the same problem from above, I apologize, but it says calculate the dollar value of ending inventory using LIFO. So we're going to go back to the shaker cup problem. Is that what it is? Dollar value of the shaker cups. So let's go back to the shaker cups for a second. I think it was here. So where's my shaker cups? Right here. Okay, here's my shaker cup problem. So this time we're going to use LIFO instead of FIFO. We're going to do last in, first out. And according to the problem, it says the ending inventory of 550 shaker cups using LIFO. So if the ending inventory is, if we're going to do LIFO, then what we have left, what we sold, should I say it this way? If we went LIFO, that means the last ones I put in were the first ones to go out. That means the ones that I first put in are still there. So the first ones that were there were beginning inventory. So I have 550 to account for. So I have 160 here. And I have another 210 here. So that's what, 370. That's still not 550. So then I have another 190. So that's 470, 480, 490, 500. 510, 520. Okay, I got to figure this out. I'm not adding it right. Let me just add it. Where's my calculator? I don't want to make a mistake because I always do. Best way to do it is to add. So I'm going to add the 160. I'm going to add the 210. And then I'm going to add the 190. Let's see how many that is. So that's 560 and we need 550. So we're going to use 180 of these left. That means 10 of these sold and all these sold because with first, last in, first out. The last one I put in was October 21st. That's gone. The last one before that was August 19th. That's gone. And 10 of the May 25th are gone. So that means I have 160 from January 1st still there, 210 from March 14th still there, and then 180 from May 25th still there. So I'm going to go back to the other sheet I was just on. I apologize for jumping around so much. But we're going to write them in right here. So again, we had 550. I already wrote down those dates. So where are we at here? LIFO. So we're going to say, okay, on January 1st, beginning inventory, we had 160 at 145, which was $232. Then on March 14th, we had another, what was it? 210 at 165 each. And that was $346.50. And then we said on May 25th, we had another 180. And we multiplied that by 152, and that comes out to $273.60. So if I add all that up, it comes out to $852.10. And that's 550. So my ending inventory for the shaker cups of 550 using LIFO method means that I have a total cost of inventory of $852. Now, if I go back to the beginning and I look at that same problem using LIFO method, we had we had $931 worth of inventory cost. So it was higher using FIFO versus LIFO. LIFO was cheaper, it was less, it was showing less profit or less expense, should I say. So LIFO is good if I want to show a higher income. In this case, I want to show less inventory cost, higher income. Where FIFO would have been better if I want to have a lower income, it's going to show it to being a higher cost. So that's using LIFO. Now we're going to do the same thing with the 45-pound weight problem. That's found here. So that particular problem said we had 64 left, but now we're going to use LIFO instead of FIFO. So in LIFO, we're going to say the last ones in were the first ones out. So the first ones, the first ones in are still there. So I'm going to go back to, where is it? It is right here. It's the weights. Yeah, there's the weights. Okay. So we said there were 64 using LIFO. So same list, but we're going to just do it here. We'll just change it here. We'll do it LIFO here instead. So we have 64 left. Well, if the first ones in were the first ones sold, or excuse me, the last ones in, LIFO, last in, first out, that means this one's probably gone, this one's gone. That means the ones that were first there are still there, right? So that means January 1st, I had 40 units at 125. So there's 40 of my 64 for $5,000. And then I had another 32. Now that's not enough. That's going to be 72. So of the 32, if I have 64 minus 40 gives me 24. So I have only 24 of these. So 24 of the units that were purchased on February 20th are still there. And those cost 108. No, they cost 118 each. So the total cost on that 118 was $2,832. So that's a total of $7,832. So by using FIFO, first in, or excuse me, LIFO, last in, first out, that's what we're using here now, even though I have FIFO down here. That is $7,800 and $837 of inventory cost of my remaining inventory after I sold everything but the 64 units. So again, if it's LIFO, it's the last ones in were the first ones out. If it's, sorry, the FIFO, first ones in, first ones out. So whatever is remaining is the last ones I put in. In LIFO, last ones in, first ones out. Whatever is remaining is what I put in there first because the last ones were sold. So you have to think in terms of that in order to figure out these problems. And that's what becomes confusing for students is remembering that. But once you focus just on what's left over, remember everything that was sold is either going to be the first things that were put in or the last things put in, depending on what method you're using. So whatever you have left is what is still there, and that's what you want to calculate the value on. So, all right, so then we move into the last, and I think the easiest method for inventory, and that is what we call, the average cost inventory method. So that's, there is a little bit of a formula that looks like this, but it's super easy. And all you're going to do is you're going to take the cost of goods available for sale, the total, and the total units available for sale, and you're going to divide it by each other, and that's going to give you an average cost per unit. And then all you do is multiply that cost by how many you have left. So in this case, 550. So going back to our problem, we'll go back to the first one, the shaker cups, because that's what we've been working with. Let's go back to shaker cups. It's this one here. Okay, here's our shaker cups, right? So doing average cost inventory is quite easy. All we need to do is go, okay, there's 110 units, and the cost is that. So let's take one. Let's take the cost, divide it by the number of units. And if we divide those two together, it comes out to $1.62 each. Okay, that's the average cost. So remember that, 162 each. So if I go back to our problem, average cost inventory problem, which is right here. right? There's 550 shaker cups left. We said it was $1.62, so 550 times 162 equals 891. That's how much my ending inventory is. I don't have to care about what went out first and what went out last. It doesn't matter. If I do an average cost of each item in my inventory and I multiply it by how many I have left, there's my cost, 891. Same thing with the weights, right? So if I go back to the weight problem, is it this one here? So here's my weights, right? No, that's not it. That's my shaker cup. So it's the next page. Hold on. Here we go. So here's my weights. So I take my costs, my 12, my 120, my 16,532 divided by 127 is going to give me an average cost. Comes out to equals $1.30. I'm sorry, $130.17. So that's my average cost. Okay, so write that down. And then if I go back to my average cost page, we said the weights, there was 64 left. So 64 times 130.17. That was our average cost. That comes out to $8,330.58. So that is my average cost. Again, I don't have to worry about first in, first out. It doesn't matter because I'm just doing the average cost. I'm taking all the total that have been put into inventory and the total dollar value, dividing them by each other, giving me an average cost per unit, and then multiplying that by how many units I have left. In this case, 64. So, all right, that's pretty much it. Question 8 is just me doing it again with all 3 methods. Do you guys want me to do that? Or are you okay?
No,
I'm okay. I get it.
You get it, Jojo?
I'm good.
Okay. Then I'm going to move on from that. Let's see what else I got. I think that's it for chapter 16. That was the last page. So, all right, great. So I'm going to end this video and then I'm going to start a different one for depreciation. So let me go back to Zoom here.